Hello, everybody, and welcome to Like a Tortoise channel. Happy Thursday, dear tortoises. If you are new here, welcome. If you are not, thank you so much for everything you've been going to the channel. I know that many of you continue to share the channel with people that you believe can benefit from everything that we are doing right here. And for that, I am forever grateful. Guys, today's video is on the market reaching is on the fact that the market continues to reach all-time highs. However, I will tell you exactly several pockets of the market that still remain attractive, and on a relative basis they actually remain at the cheapest level in decades. I'm not talking about 3 or 4 years, I'm talking decades. So that's how big a deal this is. And so even in the face of so much optimism in euphoria around semiconductors and in several of these sectors that continue to power this market higher, you can still buy quality at very reasonable valuation levels. And I will talk to you about that. But before I do that, as I mentioned in my previous video, we still have spots available for our coaching program that starts in June. So we have received some applications already. Unfortunately, I'm not going to be able to help everybody because what we do doesn't suit everybody, and I'm very clear on that. However, if you want to understand whether or not you might be a good fit, then please submit your application. You can click the link in the description and you will jump immediately on a call with me, and we will see if what I do can bring value to you in any possible way. Now, to that, tying nicely into that, I want to read this out loud to you guys because this tells you how important investment education actually is. And in the words of Warren Buffett himself, by far the best investment you can make is always one in yourself. Another one of his greatest quotes, in my opinion, is I think it's what's the quote? I mean, he has so many quotes, but and investing in yourself pays the best dividend. I think that's how it goes. And boy, is it true. So I will tell you, I'm very open about this. And some of you have messaged me saying, oh, God, I mean, why did you mention that you blew up a 10K account? Look, because that's the reality. So if you're expecting like the investment process to be all rosy, that is certainly not the case. And while I believe that the first rule of investing is never lose money, and the second rule is never forget rule number one. At the beginning of my journey, I wasn't investing at all, guys. So we have to separate these things. At the beginning of my journey, I had no idea what I was doing. I was doing what most people do these days, and that is, oh, okay, so let's open an account. I have a few bucks. Let's open a few trades using leverage. And let's see how it goes. So I didn't have any understanding of the underlying assets that I was buying, and I certainly didn't know why I was buying them in the first place, other than I was hoping to see higher prices down the line. That is a recipe for disaster. And while you can be very successful in the first few trades, that is not how you're going to create longevity in this business. As simple as that. And so if you want to double money every 3 to 4 years following a down-to-earth investment strategy that is time-tested and proven, that does not include chasing the shiny object or buying things that have already worked, then yeah, perhaps I can definitely help you. Now, I lost 10K proving myself wrong. It's too expensive, it's too risky, I don't have time. Sounds familiar? I used to say every single one of these things when I was working a demanding 9 to 5 as a software engineer. Then I blew up a 10K account because I jumped into the market without a framework, a system, or an understanding of who I was as an investor. And this is so important, guys. This is so important. You have to understand exactly who you are as an investor. And what I also draw to your attention is right here, and I shared this with our community not that long ago, our school community, not that long ago. But what you can see is that these different strategies outperform the market over time. It's not like what I'm doing is the only way to achieve that long-term wealth. The reason I do this, the reason I absolutely believe in what I'm doing and stick to my guns is because it adjusts to my lifestyle. I'm an entrepreneur. I find myself juggling different commitments from researching companies to preparing coaching materials to have one-on-one sessions with our partners. I hate the word clients. You should know that by now. But because of that, there is only so much time that I can commit to studying businesses, right? And for that, so I can't own, for example, 20 companies or 25 companies. So I had to find a strategy that adjusts around my busy schedule. And the way I achieved that was by understanding who I am as an investor in the first place. And what do I want? I love this stuff. I love coaching. I love passing on a lot of the stuff, a lot of the things that I've learned over the last years, and see people thrive and creating materials that create lots of value. But I also love doing research in hardcore analysis to save you guys a lot of time. So I do that. I work as a sort of a personal assistant. But the strategy, the core of my strategy when it comes to investing my own money in explaining, and I explain this to my clients as well, and they end up investing in the same companies as me, is guys, you don't need to devote more than 2 hours. 1 hour per week is the minimum that you should allocate towards your portfolio. And I think that is a very nice trade. I think it's a very nice trade-off for doubling money every 3 to 4 years. I mean, think about that. How many strategies in the world allow you to achieve this kind of results while devoting just 1 hour per week of your time? Why do I say 1 hour? If you run a concentrated portfolio of a few companies you understand very well, then all you have to do going forward is monitoring when they report earnings. And what you will find is that most of the time you won't do anything because these are high quality companies that have proven business models that are well established. You are not chasing the next big thing. And so chances are that whatever the temporary setback might be, they will actually come out stronger and they will continue to compound your money at very good rates of return going forward. And guys, you don't need a lot of work. We all know that Berkshire is a great company. We all know that Microsoft is a great company, and Google and Netflix. So the question here is, we already know that they meet certain criteria, certain quality criteria. Now it comes down to how much you pay to have that margin of safety, right? So anyway, I digressed, but hopefully you get the point. So many roads lead to Rome, and we choose the best combination of quality and cheapness. That's the core of our strategy and what sets us apart from core quality investors or core value investors. The market didn't beat me, I beat myself, but that failure was my turning point. I realized that successful long-term investing is not about staring at complex charts for hours. Remember, I once did a corporate job, 9 to 5, very demanding, and I still managed to achieve these results. So can you. It's about building a simple system that runs in the background. You only need 1 hour per week. 1 hour. Today, I build my portfolio around 4 strict principles. So if you are new to the channel, make sure you make a note because this is quite valuable. It changed my life, and I do believe that it will change yours as well. Meaning, only owning businesses I understand and I'm proud to own. Moat, looking for financial strength and competitive advantages. Management, finding transparent, owner-oriented CEOs. I keep pounding the table on this because, and I give you one of the best examples possible. Everybody who is working with me expects me to be transparent, expects me to tell them exactly what went right or wrong with an investment thesis. And like the same reasoning applies to when I decide to invest in a certain company. I expect that management team to be transparent, to tell me what's going on with the business, what went well, what went badly, and what are they doing to mitigate those problems. If I don't see transparency, I mean, really, it doesn't really matter how great the company is because I won't be able to sleep comfortably, right? And so, and if I can't trust the guy, then I'm out. As simple as that. Behind every excuse not to invest is just fear, but underneath that fear is the desire for passive income, inflation protection, and financial freedom. You don't need thousands to start, and you certainly don't need a finance degree. You just need a framework. And so, follow me on LinkedIn for more insights. Okay, everybody. Now let's talk about the markets. And the first thing that I want to that I want to draw your attention to is this right here. You can see how stocks have been knocked back from record highs as Gulf tensions flare. We still have there hasn't still a resolution hasn't been found to the conflict in the Middle East, which is quite unfortunate. However, as you guys know, I don't make any decisions based on macro aspects. However, it's important to understand what's happening in the world and what may cause the market to come down as a whole. But anyway, still, you can see how the S&P has been greatly shrugging off a lot of these concerns. And so by looking at that title, you would probably thought, oh my God, so the markets are down. No, they are not. And this is incredible. And what we are seeing right now is potentially one of, I mean, I'm a student of history and I've been doing this for a few years now. And I don't record a period like this one where you see so many things happening in the world that are negative, and the stock market continues to make all-time highs every single week. I mean, I kid you not. Look at this. Today is Thursday. If we close on the positive in positive territory tomorrow, then this will mark 1, 2, 3, 4, 5, 6, 7, 8, 9 straight weeks of positive trading, which is absolutely incredible, considering that the markets were already very, very expensive. I see some of investors that I respect quite a bit putting content on social media on why they would be cautious investing in the S&P at this point, and I couldn't agree more. If you are planning on buying the S&P, don't buy. Just make sure you buy the equal weight index instead of the market cap one, because you are effectively investing in tech companies when you do that. All right, let's keep it that way. And you know that about 10 companies have been driving most of the S&P 500 returns over the last few years. And you also know that this is one of the highest concentrated stock markets in history. So yeah, just be aware of that. In addition, you know that JP Morgan is, for example, projecting 0% annualized returns for the next 5 years. And I actually think they might be conservative there. But anyway, I'm not calling it up. I have no idea what would happen. My job is to find pockets of the market that deliver the best of both worlds, and that is quality and cheapness. So let's talk about them as well. And as you can see right here in our school community yesterday, so this was about 24 hours ago, I posted this. By the way, guys, access to the school community. We have almost 80 members there here. It's completely free. You can access for free. Then there are certain features that are locked for paying members, but access to it into all of these newsletters that I share on a weekly basis is entirely free. And what do I say here? I say that defensive sectors are indeed in the gutter. Defensive sectors are experiencing historic relative weakness. The S&P 500 utility sector relative to the S&P 500 is down to a record low ratio of 0.06. This ratio has declined 40% since the 2022 bear market. Over this period, the S&P has rallied 106%, while the utility sector index has increased just by 38%. By comparison, During the 2008 financial crisis, this ratio was 200% higher at 0.18. Meanwhile, consumer staples, healthcare, and utilities collectively now account for just 15% of the S&P 500's market cap. This is the lowest at least the 70s. Consumer staples, healthcare, and utilities. Guys, if your job is in one of these sectors, you have what Peter Lynch calls an edge. You understand the industry, you understand your company, potentially you understand several of your competitors, and if your stock is in the gutter, you might be onto something. Okay, so make sure you do that analysis in your own due diligence if you are in these sectors, because I think the opportunities over the next few years are going to be incredible. Defensive sectors are historically unpopular right now, and this is where a lot of the opportunity can be found. And yeah, and you can see that. So I mean, what are certain companies? A lot of you have already so we've already analyzed companies in the healthcare space and some utilities as well in the last several months. But if you don't know exactly how to look for some stock ideas, all you have to do is come here. Let me show you. I typically use stock analysis and stock unlock, but you can do stock analysis as well. And just come here to industry, right? Stocks by industry, and then you see, look, sector, healthcare. And this will allow you to find already all these company, all these different industries. So within the healthcare sector, we have medical devices, drug manufacturers, general medical distribution. Then you have financials, also a lot of them also in the gutter, by the way. Certainly technology. Look, we have industrials, aerospace, and defensive. You guys know that I don't typically like companies in this industry because most of them, not all of them, I want to be clear. However, many of them are very high. They are very capital intensive, and so the amount of capex relative to sales and operating cash flows is quite high for my liking, and so I avoid them. I typically avoid them, but you can still find very interesting companies within these industries. Certainly not airlines. But so many opportunities right here for those who already work in the industry and have an edge. And then, yeah, consumer staples. Here we go. So, for example, you have beverages. Those include the names like Celsius, Monster. Monster is the best performing company of the last 30 years in the US, which is incredible. Then you have beverages, non-alcoholic, and food distribution, packaged foods. And if you come here, this will probably where you will find Hormel and all of that. Yeah, look at that. Hormel also in the gutter. General Mills, Kraft Heinz. There is so much opportunity, so many opportunities right here. And I mean, just what can I say? It's incredible because people are saying, "Oh, but the market is so expensive." What are you exactly referring to? Because I know several pockets of the market that are unbelievably cheap, but because it's market capitalization weighted, a certain names, usually the hyperscalers, right? The ones we are talking about, and the semiconductors are driving the whole market higher. So many opportunities can still be found, and I've already given you some ideas. For example, in the consumer discretionary space, which is in the gutter. And that includes the likes of Lululemon. As you can see, the industry is apparel, but the sector is consumer discretionary. And if you come right here to consumer discretionary, you can see the average PE ratio. What the hell just happened right here? Um, uh, What? I have no idea what happened. Where is consumer? Yeah, consumer staples, consumer discretionary, and then if you come right here to apparel retail, right, or gambling or luxury goods, whatever, let's just pick apparel retail. If you come here, you will find the average PE for that industry, and you will find the several companies in it, including Lululemon, the Gap, Victoria's Secrets, right? We have so many others. Nike is not here because we would have to wear. We are just doing apparel retail. Nike would be shoes, but they will be found in that categories as well in the trading and multi-year valuation levels. And so I see, as I mentioned, guys, these are just a few examples. But it's nice when you compare then the valuation levels of those companies to those of the overall industry. So if you didn't know this already, this is something that you absolutely should know. But always pay attention to the fundamentals of the company and why you think the company the setbacks that the company is facing are not structural but more temporary. And I believe that is the case, for example, with a company like Lululemon. Speaking of Lululemon, I know that the as you can see right here, the founder Chip Wilson wins 2 board seats to end bitter proxy battle with the current board. I am so glad that they have come to an agreement, and I'm glad that as part of that agreement, 2 board members that were put forward by Chip Wilson have been accepted, so they will be part of the board going forward. And I think this will be very positive for shareholders. So I like that. And we saw the stock at one point up almost 5% yesterday. Since then it has come in just a bit, but still, why am I saying that? Because so many opportunities can be found in, because these stocks have been left for dead. And if you apply our framework that I've discussed over the last several months at length, you will be able to make a lot of money and find a lot of opportunities for when the rebound comes. And yes, everybody, these companies will come back. And when they do, they're not going to wait for you. You're not going to see the stock going up 1 or 2%. They will explode higher. And the fact that they are near record valuation, record multiple valuation levels, that it has a lot to do with the fact that the consumer sentiment, so consumer sentiment is also left for dead. And you can't make this stuff up. And unless you believe that consumer sentiment is going to deteriorate, and I think the odds are against you because they are already at multi-decade lows, then you shouldn't be buying consumer discretionary. Okay, because ultimately, if the consumer remains weaker, then it stands to reason that a lot of these companies will continue to face headwinds. But that's it, guys. So hopefully you found this video valuable. Still many opportunities in the market right now as I'm recording this video, and I think these opportunities I think the gap will close at one time, and we will be making a lot of money because we are positioned for the rebound. So yeah, let's call this a wrap. Thank you everybody for sharing, for continuing to sharing these videos in the channel with people that you know. In addition, guys, today is the 28th. As you know, we have our monthly live call on Saturdays at the end of every month. And that means on Saturday, this coming Saturday the 30th, we will have our live call. Okay, so I will share the link so you guys can join and ask me anything you want to ask, whether it's stock market related or life related or money, whatever. So guys, I'll see you on that call, and stay safe and be a tortoise.